isn't as reliable as they thought, or at least the U.S. Aid part, the security blanket, is maybe not what we thought, then we need guns. And they're going to buy a lot of them. They've already said it. But the market has said, okay, well, so you're going to spend a bunch of money on guns? That's inflation. The currencies have gone up. So the market is already there. That's not good news for those stock markets. That's monetary tightening. Equities don't like that. So again, the Fed becomes the only game in town because the Fed might actually step up easing. Well, what if they don't this week? As I suspect, you're not going to hear anything special. So you could see equities go down hand in hand here on both sides of the Atlantic and elsewhere.
So I guess my question is, like, who on earth is expecting the Fed to do something this week? Where, like, they'd be placing trades around the idea that the Fed is going to surprise. I don't know a single person.
I think it's the SCP. I think nobody, actually thinks the Fed is going to pull the trigger on anything until July. You see it in Fed funds futures. There is no cut until July. Nobody is going that way. What you do see is the aggregates for this year and next have shifted around to a more urgency of stimulus setting. At one point last week, we got as far out as 120 basis points. That has eased as stocks have bounced and people have thought, okay, no, they're going to come around, they're going to help. But if the SEP doesn't nod to some sort of additional urgency, if the press conference with Powell is like that speech he gave 2 Fridays ago, where he was essentially just saying, there's nothing to see here, guys. We have all the time in the world to figure out if all of this uncertainty really means anything. And of course, the markets are saying, yes, we're down 10% because we have all the time in the world. Yes, right. No, we need the easing now. Thank you. So I think the market is not going to hear nearly enough because they are going to get a Fed that's not jumping out the window on anything. And that could be bad for stocks, period. Be it the European stocks or Chinese stocks or whatever it is. Nobody wants a global recession here when the U.S. is the only source of growth.
I don't know. It sounds like the administration's pretty okay with a recession. I mean, just Bessent this week keeps talking about how there's going to be an adjustment period and there might be lower growth, and we
got a detox, baby.
The price to pay is worth it, right? And the stock market has got. Listen, from a certain perspective, if you want to pitch me like stocks are due to step back at the start of the year because they've gone up back-to-back years of 20% plus, fine, right? But that's not guaranteed to happen because you have back-to-back years of 20% plus. History doesn't indicate that, so I don't know if that's a fair way to pitch things.
Well, this is the key, right? It's not like the markets didn't know the tariffs were coming. They knew. The tariffs coming is not the issue. It's the way that they're coming and the actual realized growth implications of that already. Markets didn't freak out until the PMI numbers dropped off because businesses started to say, this is too much policy volatility. We're going to hold the money back and not invest and not hire. You needed to see the actual economic response. Until then, the markets were not concerned.
I mean, I think that's the bigger issue here where the market's trying to figure out the price of money in the future, and we don't know what the price of money in the future is going to be and how much economic activity we'll be able to generate. And so people have been stashing assets into cash in anticipation of whatever bills they have to pay moving forward, because how do you plan for anything? You need to have capital to do that. And if input costs are up 25% or 50%, they're on, they're off. Who knows? But, Nick, what is the most important event this week? Is it the Fed meeting? Is it Vixpiration? Is it OPEX? Is it the Bank of Japan meeting? Is there an earnings report that we're missing? Is it just paying attention to Truth Social? I mean, what should traders ignore? Seriously, like, what should we be ignoring this week? I feel like the last few weeks, if you've only paid attention to Trump and ignored CPI and PPI and, the market's been moving on the tariffs and just been ignoring everything else effectively.
Yeah, I mean, I think Trump obviously has been quite the mover for stocks. You do have an NVIDIA event at the end of the week, which is a sector that has just been absolutely a dog. Micron has earnings in the middle of this week as well. I think on Wednesday after the close, if I'm not mistaken, Wednesday or Thursday after the close. So maybe there's a bounce there, or at least gives us a reason to bounce in that sector. Micron's been kind of range bound the whole year, but yeah, NVIDIA has an event at the end of this week, a little bit of, their plans for 2025. So maybe you get something there, but I think ultimately it's always, the market has been moving on the Trump tariff tweets. And I think it's a risk to both sides. And, at this point, I think it's starting to get digested a little bit better than it was in the beginning. I mean, the moves have certainly not been as big in the last week and a half, 2 weeks. So maybe that's a good sign here. But I think the ultimate risk is to have the whole thing conclude, so to speak, the uncertainty of what Trump is going to do day to day. If that comes off the table, that is a green shoot for the market. If it was just we agreed with, Canada and Mexico and, Europe, we're going to do X, Y, and Z, and now it's over. It's done with. We're going to do this for the next, 3 years or whatever. That sort of event would be a really interesting firework for the market, I believe.
Yeah. I mean, I think that's exactly what the markets want. I don't think anybody is that concerned with any given news this way or that. What the markets are concerned about is uncertainty, because they can't go and price risk. Mm-hmm. If they knew what was coming, they would go, right, okay, so let's discount for this scenario. In this world, this asset should be higher, that asset should be lower. They would take some sort of digestive period and we'd be fine. I think this is what's so critically different. If you looked at what's happened in January, February, March to stocks this year, it's tempting to say a new administration has come in, it's moved fast, it's knocked a lot of things over, but it's getting to where it's got to go in a hurry. It's reorienting hard. Once it sort of sticks in a spot, once this is done, once the mad dash is over, things will even out. Well, that's only true if people know where the mad dash is supposed to land at and plan for that. But they don't know. And since they don't know, the uncertainty continues to swirl. And we already see it appear in the places you don't want to see it appear. That is business confidence, the PMIs, and consumer confidence. The University of Michigan consumer confidence numbers just came out on Friday. They were horrendously bad. And so when you look at that, I mean, they were expected to be bad. They were worse. And so 16-month low was expected. We got one, but it was lower. And so we have very serious concerns here, clearly. Consumers are concerned. They think the tariffs are going to be inflationary. Their one-year inflation expectation is back to 4.9%. That isn't to say that we're going back to 5% inflation, but people do fear that we are. They're going to claw back consumption as a consequence. They're going to say, you know what? If prices are going to be ramped up again like this in just a year, I remember what this was like. The last time that inflation was running that hot was 2022. Just as the Fed started to have an effect and started to cool things off. So, okay, we know what that was like. Things were really expensive and painful. Fool me once, shame on me. I'm going to be ready this time. And they're going to claw back spending. And the U.S. economy is 70% household consumption. This is not what you want. This is now a real growth risk. This is not just sentiment.
Yeah, and I think one of the important things to understand about the state of policy right now is that with the continuing resolution that was just passed, it freezes it's a static top line spending bill. And so with inflation, that means real spending is actually going to decrease a little bit over the course of the year. So that is a way to take aggregate demand out of the economy. And they're clearly attempting at trying to take aggregate demand out of the economy right now.
Question is, do they mean to?
I mean, it's again, if you're trying to get the economy to slow down a little bit, reducing growth, one way to do it is to take away the carrot of government stimulus in many different forms and fashions.
Sure.
Even if we don't agree with it, right? So that's just how they're going to do it. I think, right, it could be carrot or stick. They choosing this path. Let's get off the stocks and macro level shtick here, though, and maybe evolve that conversation. Nick, what are you thinking about the metal space, about commodities here? You mentioned you're trading oil recently. I have not placed a trade in crude in months. I find this to be terribly boring and uninspiring with a 28.1 IVR. How are you having more confidence of approaching it? Because I'm looking at it from the vol side, and I find the vol to be uninspiring.
Yeah, I mean, it's something to diversify in when you're, feeling the pain in some of your long delta positions. Sometimes you look for something that isn't as painful, and this has been, kind of chop fest between 68, 78 for the better part of the last 6 to 8 months, and so I've been trading around that. There's all sorts of ways you can play it. The micro crude contract is great if you want just static delta MCL. Options are liquid. I mean, volatility right now isn't super high, but it still moves, and the markets are liquid, so you can get into positions there. Some of the stocks that are obviously high beta to oil, XOM, CVX, they've been kind of dead money for a little while, and it's been kind of a long thesis there. I've been listening to too much Thomas Westwater. I mean, he gave me the short natty gas, long oil proposition, and it's worked out over the last week and a half-ish. Took some pain on the natty gas side, but it's starting to come in a little bit today.
Ilya, oil to you, I think, has been something that has no business rallying here. Natural gas is a different story. Oil, though, today it does try to stage a bounce back above 67.5. It really can't get through there in the CLK5 contract. You see the swing lows in mid-December. You see the 1 month moving average here, the yellow line today. We run into it and immediately sell off. Why should we have any faith in oil staging a significant rally from these levels?
I don't think you should. I think oil is very much a part of this cyclical story that we've seen. The kind of tepid rebound in oil rhymes for me with the tepid rebound in some of these defensive names and defensive sectors on the stocks side that says, okay, the Fed's going to come rescue everybody, is going to be okay. The demand story is not going to fall off as much as we could, because the Fed's going to ride to the rescue and offset this. So let's be defensive, but let's also not assume that growth is falling off a cliff. Otherwise, when you look at this story, what do you have? The administration wants to pump more oil. They don't have a lot of room to pump it because we're already at records.
They backed off that. Their official energy plan no longer has drill, baby, drill as part of the 9-point plan.
Oh, I see. Well, there you go. It might be because we're already producing more petroleum products than Saudi and Russia combined.
Way to make a big deal of that announcement, right?
No, that one got swept under the rug. I missed that, but it's not a shock that I missed that one because it changes day to day.
Well, that's the whole thing. Is we're going to have somebody. So somebody compiled a list without drill, baby, drill, and then somebody is going to come out into the press room, and I'm thinking about the president here, and say, "What? No." Sort of like the tariffs were delayed until April until they were not, because apparently somebody told the president that they were delayed, and he very promptly turned around and said, "Delayed? Get out of here!" No. So I don't think the administration knows internally exactly what the specifics are near term, or at least what the timelines look like. Seems to be a lot of cooks in the kitchen. But when you look at sort of the scope, they're not looking to go the other way. They're not looking to constrain supply, and supply is very abundant already. You could ostensibly, if you wanted to increase supply, create pathways to encourage the restarting of wells, because all of this record supply has happened with the number of active wells and fracking installations declining, because we're getting more efficient. We're getting more out of what's there. you could, if the administration were to encourage everybody and give them some tasty inducements, you could restart more capacity. But if prices fall very much further, that's not going to be economical. So it's going to screw up a lot of people's profitability on the extraction side. They're going to fight it. So if anything, supply is neutral to slightly higher. Demand is the real issue. Geopolitics hasn't been a big consideration for a while, and for good reason. It looks like we're very much heading in the direction of de-escalation, and we'd benchmarked these things as not really disruptions months ago. So I think the main story here, as ever, is recession risk and cratering demand. And if the Fed doesn't come to the rescue, that's bad for stocks, it's bad for cyclical commodities, it's bad for the dollar, it's good for bonds, sort of on and on and on and on. It's all one thing.
Nick, you mentioned there's an NVIDIA event later this week. Is our market savior coming down the pipeline? Is Jensen coming here, riding in on a white knight like Gandalf with the Riders of Rohan to save Helm's Deep?
I believe so. I don't think this is a product event. I think it's more like a developer type event. So okay. I don't know if it's going to be as, I don't know if Gandalf is coming on his white horse to save the Rohirrim, but I mean,
making me look like a real surface level fan by name dropping the correct terminology there.
Well, I had to, but I that's just another thing. It seems like there's a lot of things this week. There's a lot of events this week, and if I know anything about events, volatility usually stays bid. We're not seeing it stay bid, which means that, or at least which signals to me that we've already kind of gone past this. And after, all these things come to pass, that's usually, you get to all the info is out there. There's no more questions about what Jay Powell is going to say. There's no more questions about, the dealer positioning into Friday's expiration. There's no questions about, how much short vol there is on Wednesday. All that stuff is going to be over with at the end of this week. And, after a 10 or 15% downside move, I play the upside. That's just like, how I look at the short-term markets. Longer term, I mean, yeah, sure, things don't look awesome right now, but I think there's, as always, a lot of, and especially with who's in power right now, there's a lot of scary things that could slingshot up, is how I feel about markets and some of the stocks underneath the surface.
Do you feel like there are opportunities outside of semiconductor names besides NVIDIA? I know several months ago you and I were having conversations about ASML. It hasn't really been punished here, though, the past several months, right? Like this has just kind of been moving sideways while everything else has been slinking up and down.
Yeah, I mean, some of the other bigger named stocks, ASML, you've got TSM, which hasn't really moved in that direction. Even Intel, you got new CEO at Intel, and the potential for bringing some of that stuff more onshore. I mean, I think that's an interesting story as well. I mean, across the board, everything's at a discount. I've been looking at like cybersecurity names like CrowdStrike. Some of the Coinbase, Robinhood. I mean, these stocks have gone, they're 30 or 40% lower in the last month. I don't know if I can say that's warranted.
Ilya, I know you're not much of a single stock guy here, but is there a stock or a group of stocks that you're paying most attention to right now as a bellwether for how you look at broader risk appetite? It could be a tariff name, it could be an AI name. What's on your mind?
I mean, I think if you want to think in terms of single stocks, Tesla necessarily has to come to mind, because if you're thinking about it as a barometer, basically on what the markets think of the political implications, This is probably the closest. And so, just as a sentiment read, this is something to look at. The news is replete with all the stories that at least at a very surface level start to go, oh, people are turning in their Teslas. There is a big market out there for used Teslas all of a sudden because of discontent with what's going on. People on social media go, when I see a Cybertruck, I'm going to key it. Things like this.
Isn't that so funny, by the way?
Friends of mine that are not in markets are
10 years ago, Teslas got keyed because they were seen as too liberal.
Yes.
Teslas are now getting seen because they're coded as right-wing.
I'm saying, right? So it's like you
10
see
years ago was the time to buy it, too.
MAGA hat images start to conjure for people. Like friends of mine who are not political, who are opportunists, are saying, I'm about to get a Tesla at a discount. I'm over here waiting for this market to come in a little bit because I'm trying to buy a cheaper Model 3 used. So, and this is now in the zeitgeist then. This is just sort of regular people. They're not thinking about markets. They're thinking about Teslas. So when your buddies are organizing the protest to sink Tesla car prices so that they can buy the used cars. Oh, I guess it's not insider trading, right? No, it's fully out there. I mean, and these are secondhand models. They're not trying to buy new Teslas, so Tesla's not going to see any of this money. Not that they'd care. They're just trying to get some cheap Teslas. And so when I look at all of this and I see it sort of show up at the man on the street level to this extent, it's only nominally the price of a stock. It's more so a sentiment gauge at this point. So I look at it in those terms.
Speaking of sentiment gauges, I suppose this is a sentiment gauge for us to think about here. Ilya, I texted this to you and Radigan on Friday night, and I said the S&P is probably good for 3% this week, right?
Yes.
Ooh. Okay.
I like that. He's back. My man's back. I thought I lost you for a while, Chris.
Mind you, this is not this week's cover. This is the previous week's cover.
Ooh. Yeah. So we talk about and the Economist covers, right? Actually, I gave a presentation a number of years ago out in Las Vegas at a trading conference about how you can use popular media as a sentiment gauge when they do inflammatory headlines like this. Thinking specifically about
the YouTubes, you could find it.
Yeah, if you look at summer 2011, The Economist ran a bunch of covers talking about how, like the euro was falling off a cliff going into 2012. The euro is falling off a cliff. They had pictures of George Washington with a black eye on the cover to talk about the dollar demise. And whenever they do a George Washington black eye cover, it's like within 4 weeks of a significant turning point of the U.S. dollar.
Yeah, buy some dollars. The moment The Economist has the black eye cover, go buy dollars.
You talk about reaching the everyman here. I think The Economist, listen, I enjoy their writing. I agree with a lot of their perspective.
I love it. I read it religiously every week.
I think that they have people that run their these choices of images that are very much like Steve Buscemi, how you doing, fellow kids? And so they kind of arrive at the zeitgeist after the market's already made that move. It's become a story.
Public, right?
This is the story of public. So
this is public.
So I would point to this, and then there was another chart that I shared in the chat and research here, which I'm going to pop out right now. In terms of CTA selling right now in this market, I'm just going to pull this up on the screen, right? CTA selling in this market, lowest net short, or rather the most net short CTAs have been since October 2023. I think the point I'm getting at here is that we're probably at an extreme in sentiment right now. And so if this week comes and goes without any big kerfuffles, I know this is futures roll week, the opportunity for a short-term squeeze higher exists. And so if it's ESM 5, that's about 58.55 to the 1-month moving average. That brings you right back to the swing lows that you have in October, in November, in January. For ESH 5, it's about 5,800 right now. And Ilya, that would set us up with the opportunity to sell back at a neckline and a potential double top if these recession concerns persist. But you know what? We're going to have to cover that all tomorrow because overtime is now out of time for this Monday. We're back Tuesday, as we are every Monday through Thursday, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, our guest host, Nick Batista in Chicago, I've been Chris Vecchio in New York. We'll see everyone later. Of course, after this, take a quick break, get some water, come back. Ilya Spivak's here with Macro Money.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Make your move, genius. Tasty Trade.
Stocks go up and stocks go down. Markets move. Beta is a way to measure the movement of a specific stock relative to the market as a whole. In simple terms, it tells us if the underlying has more volatility of price movement relative to the S&P 500. Beta of 1 is our control here, SPY being the underlying. If the beta of a stock is less than 1, it would mean the stock typically moves less than the SPY. If the beta of the stock is greater than 1, it means the stock tends to move with greater volatility than the SPY. It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
So I started trading in the equities market when I was 18. Real basic ETFs, mutual funds. I didn't discover options and really Tasty Live until about 2012. It made sense to me from a risk perspective. And so I started trading and never really have looked back. The people you see that's who they are. They're trying to be as open and clear as they can with the trades that they're putting on. Teaching a methodology, like teaching the logic behind things. It is tried, true, and tested. They back it up with research. They share that research. It's not just trust us and do this, which is a very dangerous thing in the financial world. But learning about that in the Tasty universe, it starts to prove itself out, right? When you follow the methodology, you'll see those profits and you'll understand why a position did what it did. You know, sometimes the market wins and sometimes you have a 90% winner and you don't know, why don't I do this every day, right? This is easy. But you kind of have to reset that and just go, okay, close the trade and move on to the next one, which is really what Tasty's about.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
The markets manage a little bit of a pull-up as last week ends and this week begins, but do we have the ingredients for things to keep going? Macro risk calendar for this week suggests maybe, maybe not. It's loaded with central banks once again, and of course front and center for them, the Federal Reserve. That's what we're going to unpack here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we have to consider here after what has been a painful sell-off across a whole range of markets here is, will we finally get the relief valve that the markets have so wanted to see? And that, of course, is cheaper money. And as it comes to cheaper money, the real question is cheaper dollars, because, of course, as we've talked about at length on the show before, the dollar and the cost of borrowing dollars ultimately determines the cost of borrowing globally because of how ubiquitous the dollar is in global commerce. The latest numbers from the Bank of International Settlement, not quite updated yet for this year. They update every 3 years. The last one we have is 2022. They show that the dollar still accounts for close to 88% of global monetary transaction settlement. And that number hasn't really moved very far away from 80% in decades. In fact, it's only gone up in recent years, largely because the role of the euro has diminished. And so what we're looking at here when we talk about the stimulus function for these markets that are now concerned, it becomes a question of, well, if the Fed sets the cost of borrowing dollars, then it sets the cost of borrowing, because almost all economic activity is transacted in dollars globally. And so the cost of borrowing to finance that activity lines up neatly with the costs of borrowing dollars. And that, of course, is set by the Fed to a large extent, or at least guided by the Fed. And so the real question then for markets is, will this week's Fed policy announcement be the help they've been so desperately pining for? But let's start the conversation with why they're pining for support. We have yet another down week for stocks last week. S&P down 2.4%, NASDAQ down 2.6%. A little bit of a wiggle higher on interest rates, but only a wiggle. Bonds still very much net up over recent weeks against the backdrop of this sell-off. And last week we get basically standstill. The long end of the curve had a little bit more of upside mobility 2 weeks back, but the overall thrust seems to be that after a protracted rally around these expectations that the Fed will perhaps do more vis-a-vis policy support, we have bond markets that have moved meaningfully higher off their lows over the past several months and now are in some sort of digestion mode as that is absorbed. We nevertheless get more gains in gold. Crude oil, after a protracted decline, again, seemingly around recession worries, manages to just eke out a flat result. And the dollar keeps falling in a telling sign against the basket of major currencies, both the euro and the yen, as kind of bellwether counterparts. They manage another week of gains last week, although the process has slowed some. Certainly not the kind of 4.6% rally that we saw 2 weeks back, but nevertheless, almost a percent added for the euro and over 0.5% added for the yen. So the thrust of the story still very much is growth concerns and what the Fed would do about it. Now, it seemed like in the first stages of the stocks sell-off from late March, what we saw was perhaps the idea that with a market signal, that is to say, with the data showing signs of growth coming apart and the market selling off on that, and that data screaming that the reason for the consternation, be it the PMI numbers or the consumer confidence numbers, PMI is, of course, a measure of business confidence, if that's ultimately going to scream at policy officials about there being consternation about their moves and the speed of them and the way that they're being delivered, that there would be an adjustment and that this would be a source of relief. But everything that we've heard has instead sounded more like saying this is a necessary adjustment. There's a period of transition that has to happen, and the administration is okay with the level of market selling that has transpired so far. This is the message we've heard from the president, from the Treasury Secretary, and so forth. And so the markets have instead said, okay, well, if on the fiscal side of the ledger, they are okay with this, on the Fed side, the monetary side of the ledger, there might start to be conversations about perhaps we need to dial up stimulus to make sure that we're on course with our growth and inflation targets. Otherwise, we might veer off if the economy weakens suddenly. And so that's what the markets have been hoping to see. Now, we get the first real test of this idea with this week's policy announcement. It is one of the big quarterly announcements where the Fed is going to not only deliver its rate decision, but also, in addition to the policy statement and a press conference with Fed Chair Powell, give us updated numbers for the summary of economic projections. That is to say, what the Fed expects for growth, inflation, and most importantly, the path of interest rates for the coming 2 years or so. The upshot, of course, is that these expectations are not the Fed's official expectations, in the sense that it isn't the institution, it's each individual policymaker on the Fed board gives their forecasts, and then the Fed publishes the median of those. But it does give a very good sense of the consensus on the committee. And when we look at where the markets think this is going at the moment, we can see the Fed, of course, got very dovish in September. The markets since talked them off that ledge. And already we can see that by November, on this policy curve implied in Fed funds futures, we were already at a much less dovish setting and haven't really moved around very much since then. Basically are sitting right around there across the subsequent policy announcements. So from September to November, we make the change, and then subsequent meetings in December and January leave us about in the same spot. The sort of structure of the curve for now seems to be a little bit more of a bias to stand still up front, with a little bit steeper of a shift toward cuts downwind. And We see that with the current median rate at 4.38, that's of course the middle point between the Fed's current target of between 4.25% and 4.5%. No changes. We're at the median for this month, for April. We're starting to flirt with cuts in June, and the first cut is fully baked in. That is 38 minus 25 basis points right here for July. If we look at the overall tally here, we do see, of course, that all this consternation about growth has marked a sharp, dovish revision in expectations. So about a month ago, we only saw maybe 50 basis points in cuts for all of this year and next. Now we're looking closer to 100 basis points, sort of hovering around this mark right here. We got as low as 120. We're now at about 90. So sort of hovering around the 4 rate cuts tally, which is actually in line with what the Fed initially told us in December. We can see here the Fed was looking for 50 basis points this year from 4.4 to 3.9, and another 50 basis points next year from 3.9 to 3.4. Now, if the growth concerns in any way shape these numbers to give a more dovish view, well, then the markets ostensibly are going to feel that this readjustment that they've made has been vindicated, and of course would take that as a sign of encouragement. But if instead the Fed says, you know what, we don't see a crisis that would allow us to back away from wait and see mode, we of course acknowledge that there's been some concerns about growth, but lucky for us, as we just heard from Fed Chair Powell 2 weeks ago in a speech, the Fed has the benefit of time. There's no sudden surge in the unemployment rate. Inflation isn't running away in some sort of weird direction. So we're just going to sit on the sidelines here and do nothing. Wait for more confirmation. That's perhaps not what the markets want to hear, considering all of this adjusting. And if then the Fed disappoints in this way and basically doesn't do much of anything, then the message for markets will be, well, this means that they are delaying now, so they're going to be late to fight whatever economic downturn now looks to be on the menu, which means harder cuts later. And so what we might see then is, as a consequence of all of this, this 30 basis points or just over one cut that's priced for next year might start to become a much larger number. And the upshot, of course, then speaks to lower bond yields, especially at the long end of the curve, and perhaps a still weaker dollar. Now, the Fed is only one of the major central banks announcing policy this week, and each one has their nuances. The Bank of Japan due for a policy announcement. They are expected to hold rates unchanged. And as we see here, the curve, their policy curve, this is the only central bank that's expected to hike this year. So you'll notice the Fed policy curve is pointed down because they're biased to cuts. Japan's policy curve is pointed up because they're biased to hikes. And we can see here that by the end of the year, we're looking in excess of 75 basis points on the rate. That, of course, means one more rate hike from now. We're at 50 basis points now. And you can see that we don't have any changes. This right here is the spread between the current rate and what these curves are saying. So we don't see us get back over 25 basis points, that is to say, to price in the full cut, until we basically get to November. And then no more after that. And we can see the curve has been fairly static from this month to a month back. So with that in mind, one more hike, and there's not really a whole lot of speculative interest around the idea that maybe there's more that could be on the horizon. But at the same time, the situation growth-wise is heating up. We see increasingly fast Japanese composite PMI numbers. They're telling us that economic activity growth has rebounded to the fastest since September of last year after this dip in the fourth quarter. And against that backdrop, inflation has surged and is back to 4%. So it could be the right time for the Bank of Japan not to change policy suddenly, but certainly to signal that maybe they're prepared to be more hawkish than current pricing anticipates. Or perhaps maybe that rate hike could come a bit later. They're waiting to see, ostensibly, what wage negotiations look like as their fiscal year ends this month. And so with that, perhaps the Bank of Japan might signal that after these wage negotiations and where they see things settle, we could get more of a hawkish perspective, which might be the fuel that the Japanese yen needs to continue to reflect falling U.S. interest rates. If you got a hawkish BOJ coupled with a Fed that isn't prepared necessarily to cut and run and cut early, the upshot might be a yen-favored shift at the longer end of the two countries' yield curves, where rates in Japan had higher, rates in the U.S. had lower at the longer end, and that's exactly the kind of ingredients that the Japanese yen would need to continue to rally. It's already staged a pretty impressive advance so far this year, and it could find fuel for more of the same. And then the Bank of England will issue its policy announcement. A very similar story here to the Fed, where September was very dovish, and then we ended up in a kind of choppy range. Since then, the markets came off those extremes and have since been sort of stuck in a band here from November to December to February, now going into this meeting in March. The BOE doesn't meet in January. And you can see that, again, no cuts on the menu for this go-around. So we can see we don't get down into rate cut territory until June, 450 down to 423. And then we get another cut by November and sort of tilt a little bit lower by year's end. And what that shakes out to is 58 basis points being priced in for this year. That is to say, 2 cuts with about a 32% chance for a third, and stand still next year. Now, the key here, again, is the guidance. We're going to start looking at what the Bank of England has to say about whether this forecast still makes sense. And there is, of course, the knock-on effect to trade for them to weigh. But more importantly, the recent tensions between the U.S. and Ukraine have really perked up interest in the major continental and, of course, the UK capital. It seems like for the first time really in ages, London, Paris, and Berlin are prepared to hold hands and rearm together and in size. They seem to have concluded that Europe needs to be much more independent in its defense and not so reliant on a U.S. security umbrella that has basically guaranteed European security via NATO since the end of World War II. Now, they seem to be scrapping debt limits in Germany and variously plotting out big splash defense spending in France, in Germany, in the UK. And not surprisingly, of course, those are the main military powers on the continent. And all of that has already shown up in the bond market. We can see this creep higher in UK bond yields already starting to speak to this. And of course, the trend has been higher for quite some time, but even just more recently, we've seen this start to perk up. So before all of this spending ends up in the corporate earnings of European defense contractors, and maybe even U.S. ones, the markets are anticipating that a big fiscal impetus will show up as inflation expectations. And to the extent that the Bank of England is prepared to talk about this, and flag it as an inflationary risk, the pricing for rate cuts this year could start to look a bit rich. We could start to come in for one cut with a chance of 2 rather than 2 and a chance of 3. We might start to entertain the idea that next year could ostensibly even see a move in the opposite direction. Obviously, the euro has been a little bit more responsive to these moves, and already for the eurozone, not only have expectations for ECB rate cuts come in significantly since they last met, but the markets now put at about a 50-50 chance that the ECB will hike rates next year. A similar adjustment for the BOE, assuming that they say the right things, as the ECB did, to encourage that level of thinking, that could start to look like another rally for the British pound. And, of course, that would continue this sort of anti-dollar move across the board. But it would certainly catalyze a larger one here, especially if at the same time you get a backdrop of a Federal Reserve that seems to be delaying. So not only would you then get the implication for the markets that the Fed might not be ready to do something now, you would start again to build more into the back end of the curve, which actually would line up quite nicely with building up more tightening into the back end of the UK curve. So again, as you start to focus on next year's policy path, given a Fed that isn't seemingly in a hurry, you could get these yield spreads send the dollar especially lower in a broader dollar sell-off against the likes of the euro and, of course, the pound. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am also on Futures Power Hour with Chris Mondays and Fridays, on with Victor Jones for the Price of Truth this week on Wednesday, usually on Tuesday, this week on Wednesday. Mark your calendars for that. It'll be a conversation right after the Fed policy announcement, so no doubt replete with all manner of spicy conversation and analysis. We are going to be back with Chris for Futures Power Hour Friday, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
from the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap. Why are we literally rolling out the red carpet? What has this diva done?
I know, I saw that. Why do you got a little red carpet?
Diva.
I don't like it. They said it's
sound.
Do we have a wide shot of the studio? They said it was sound. Yes, my lord.
And do we have to clap when you walk in?
Where are the rose petals? Wow.
Vanetta.
Hello. Yes. Good morning. Ooh. Yay.
New phone. Who dis? I did go in and get the phone at AT&T, and I didn't realize.
You went in unsupervised?
I went in by myself without a helper.
Did Beth have to pin all of your information to your jacket? It was like, my name is Tom Sosnoff. I need help, but I am an independent person, but I am looking to buy a phone. Here is how much money I have available. If I need help, you can call Beth.
I can send you some viral pictures of my corned beef.
No, that is a terrible sentence. I do not want pictures of your unseasoned beef. No, ma'am. No, ma'am. You guys are elderly?
I'm the only one in this room that's never been in an accident.
That you've reported. See, I report my accidents. You don't report your accidents.
You don't report your accidents. Other people report your accidents.
They hit me. There was nothing I could do. They hit me. I was standing still. They hit me.
I've heard this story.
Okay?
You're the only one in this room that's ever run yourself over.
That's true. That's true.
Classic.
That's true. No. You're the only one that had to sue your own property insurance because you backed your car up into the garage.
Oh, yeah.
Didn't sue anybody.
You're the only one who's had their mirror kicked off by an angry cyclist.
That's true.
This is fun.
Forgot about that.
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, $4,000. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
And Cecilia and Dan, we've got a special show planned. We've got KG and Cole from Valmex here. We're going to talk volatility, talk their product, talk what's going on in the markets. But before we do, Cole, KG, how you guys doing?
Good, thank you. Doing great. Thanks for having us. Excited to be here at Talk Shop today.
Absolutely. We're excited to have you here as well. I hope you both had some wonderful weekends. But we're not going to mess around. Let's just jump right into it. Typically, we go through the markets and give our opinion, but we'll do that towards the end. You guys are some of the first guests that we've had on in a while, so excited to fire that back up. But you are behind Valmex Indices, some leading volatility products in the space. I think before we get started, maybe if you guys want to just give us a little bit of background about yourselves, and let's jump into what you're doing at Valmex.
Cool. Great to be here. This is Cole from Volmex. I'm the founder and CEO of Volmex Labs. Here with my colleague KG, there's a little bit of echo on my end. Can you guys hear that, or is that just me?
I think you're coming in okay on our side.
Okay,
but,
cool.
Yeah, we'll iron out any technical details here.
So TLDR, we build the leading Bitcoin, Ethereum, Solana volatility indices, kind of like a VIX-esque index for the Bitcoin crypto markets. 30-day rolling implied vol. We have a number of other indices which we've recently rolled out that track different things like interest rates, fixed income, other sort of metrics. And so quick background on myself, I've been working in crypto startups for about 6 years. I have been following the options market and vol market my entire life. My dad actually spent about 30 years working at a couple different U.S. equity options exchanges. Did a lot of trading in my PA and, saw the void for this type of product in crypto. That's how a little bit on Volmex's history and my background. KG is a super interesting background. KG is our head of research. I'll let him jump in.
Thanks, Cole. Yeah, thank you for inviting. This is KG, head of research at Volmex Labs. Prior to Volmex, I was in TradFi space, working for an HFT company. I have a PhD in finance. I was focusing during my PhD in the volatility research, especially option pricing, volatility modeling, volatility forecasting. So applying those in the crypto area and building the implied volatility products in Volmex Labs.
Awesome. Well, we appreciate you guys again for coming on the show. I'm just curious, what prompted you to start Volmex, and how long ago did you guys start it?
Yeah, so we've been in the market thanks, Ryan. We've been in the market for the last couple of years. Got formally started in 21. So as mentioned, I followed the vol product space, option space through, my dad, who's worked at a couple different U.S. equity options exchanges. Deribit was getting very liquid. Kind of noticed that there was no leading, de facto vol index standard, and we kind of got started on, building out an indicator, early version of BVIV, our core index, as well as some tradable products around it. And so basically we saw, a major opportunity to build a tradable vol product, a pure vol product in crypto that made it really easy to trade vol in a very seamless and intuitive way via perpetual futures. And then also there was no sort of leading index indicator standard. And so, the rest is history. We got started a couple of years back, and, building an index takes a lot of time to build track record, to build reliability, trustworthiness. So we've been in the market for the last couple of years. I think the market is now finally ready for this type of product. So it's kind of a confluence of the right team, the right product, and the right timing. And so really excited about where we're at right now.
Yeah, now if we can, we've got volmex.finance here in our browser. If we can just throw that up so everybody can see what we're talking about. If they want to check it out, go to volmex.finance and you'll see what we've got here on our screen. How does somebody get started? Is this something that, obviously you have the indices. Are they tradable? How do you access some of the dashboards or the data here? And then we can talk about how to use it.
Yeah, so I'll take this one. So our indices are available via a number of different platforms. So you can go to charts.volmexfinance, which is kind of our own charts page, which has over, has our term structure, has BVIV, EVIV, SVIV, MVIV, the Bitcoin, Ethereum, Solana, volatility indices we built. As mentioned, we have a BVIV 1 day, BVIV 7 day, all the way out to 180 day, term structure. And so number of different indices available here. We have a variety of realized vol indicators, correlation indices, all available on this platform here. For about 2 years, we've had these really great integrations with both TradingView and CoinMarketCap. And so if you go to TradingView, tradingview.com, and you search for Bitcoin implied, Ethereum implied, Solana implied, Volmex's indices are actually the top results for those. And so, we're available on TradingView. We're also available on CoinMarketCap. If you go to coinmarketcap.com/charts, they have a whole dedicated section in the mobile app as well as on the web app about Volmex. And we have integrations with the Block, Levitas, and then we have a variety of APIs. We have an enterprise API offering. And it's, whatever sort of platform for data, you use, we have that, integration, coming or already built out. And then we have a couple of tradable products in the market and more coming soon. So we have this collaboration with Bitfinex, which is notably the sister company of Tether. And so if you have an account at Bitfinex, you can trade the BVIV, the Bitcoin Vol Index Perp, or the EVIV, Ethereum Vol Index Perp. And then we also have a collaboration with Arbelos, which has recently joined FalconX. And so those guys will also make markets OTC on the BVIV index. And so it's tradable through a variety of different wrappers and accessible in terms of data through a variety of different platforms right now.
Awesome. So I'm assuming for tastylive viewers and a lot of the traders at the tastytrade brokerage, they're going to be U.S. based, so might not have access to Bitfinex products or to perpetual futures. So, hopefully that's coming soon. We'd love to get your view on that in a second. But is it fair to think about this in almost a similar fashion as I would think about a VIX future, where while this is obviously related to Bitcoin or to Ethereum, it's going to allow me as a trader to express a view on volatility, or possibly I could use this as a vehicle to hedge? Is that kind of the primary use case, or what do you guys see in terms of how the indices and the trading or the perpetuals are used?
Either I or KG can take this one. KG, you want to take this one? I'm doing the last couple of questions.
Oh yeah. So basically, main feature of volatility is, especially when there's a negative shock in the market, volatility goes up. So that's why, if you put it in your portfolio, it could be a good hedge against some negative jumps in the market. So that's one type of use. The other one is you can get a speculative view of the market, volatility market. So basically, we can see some vol spikes. So those could be good opportunities to sell because of the nature of the volatility. We see sudden spikes and then goes back to the kind of mean. So it's the mean reversion of volatility. It's a very important, well-known feature of volatility. And also, if it goes down to some lows, we can expect, at some point volatility will go up. So like speculative view, you can trade for hedging, you can use it. And also if you have an option portfolio and carry some Vega, this could be a product that you could hedge those exposures.
Yeah, as I was poking around in here, one of the things that I came across that I really like, let's just look at BV, IV, or BVIV, is that you guys have the rank as well as the percentile in here. And I'm assuming that's just looking at where is the current implied volatility relative to the range that it's been in over a certain period of time. Is it fair to say then that one approach to this would be, okay, I want to trade, let's just say I want to speculate on volatility. I believe that it's going to mean revert. Would you look for the rank to be kind of towards this end of the range, closer to zero? That maybe presents an opportunity to go long versus I would short the perpetual on the other side of that if we were closer to 100 or we're closer to that 99th percentile?
Yeah, I think as KG mentioned, when the market sees a big spike in volatility, it will typically revert back to some sort of it'll always revert back to some sort of long-term, medium-term mean, depending how you're looking at it. You could also think that, there could be some mean reversion, different types of mean reversion. That's kind of the most topical sort of use case is after a big spike, say the rank or the percentile is towards 90, 100%, should come back to some sort of long-term, medium-term mean. And so that's a very classic use case for implied vol. It's, going to mean revert after a big move up. And so that's kind of, I think, very, very topical and something for the listeners.
Since you guys have been in this space, what do you see in terms of the larger drivers around crypto volatility? Where obviously we've had points in time where you've had forced selling post FTX, you've kind of had these big boom and bust cycles that have gone on throughout history, the short history of crypto, but seemingly quite frequently. Have you seen that change at all? In any way, is it more macro driven? Is it still relevant to what's happening in the crypto markets? What are the big drivers of volatility?
Very analogous to the VIX index. When there's a lot of fear in the market, the BVIV index tends to always spike. So it's a very, it's a fear gauge, just as the VIX index is, with the US equity market. And so I think that, that's a very positive, that's a very negative correlation, very strong, persistent negative correlation in times of fear, BVIV and the spot market. It's interesting, it's a bit different from the VIX in times of greed and excitement in the market. You can observe at some points a positive spot vol correlation when there's a lot of spot buying. And so, as spot gets bid, options get bid, vols are increasing. And so, for example, during the earlier last year with the ETF launch, there was some, a lot of positive spot vol correlation going into some of those launches, followed by a vol crush, which is, pretty intuitive. And we could talk about that for listeners as well. But so, very negatively correlated times of fear. It depends in times of greed and positive markets. Perhaps it's very positively correlated with the spot market. But yeah, it's a bit different for risk assets than the VIX index in times of greed and positive price action. KG, what anything you want to add there?
I can make some additions on top. It could be in the last year we can see that there are two things. There are volatility coming from actually itself from the crypto industry, but also there are some volatility or a factor which is dampening the volatility, which is the I think ETFs, we can say that. So since the introduction of ETFs and inflows, especially inflows are key here, we saw in the last year implied volatility of Bitcoin or BVIV index is now much less than EVIF, ETH implied volatility index. So this type of like differences, that could happen because of the inflows, and we can say that this is because of some like macroeconomic factors. One is, for example, like when we see interest rates are decreasing or signs of quantitative easing, we see more inflows into the ETFs, and those are priced also in both BTC and also implied volatility in our index LIV. So that's why we see like more inflows, introduce more stability into Bitcoin, and that's how we now see much less values of BVIF in comparison to EVIF. So like this type of factors are quite important.
Do you think that we're likely to see that should we get a Solana ETF possibly later this year? Obviously, we have the ETH ETF. I mean, have you observed that in other products as well? Because we got that question quite a bit early on here, where it's like, okay, with these ETFs, the further institutionalization of the space and maybe alongside that risk controls and the way that these investors behave, are you going to see muted levels of volatility? Are you going to continue to see volatility almost dampen in this space over time versus what we've experienced over the last few years? Do you think that we'll see that across Ethereum and Solana and any others that are kind of given that ETF wrapper?
So it has that potential. So like, potential is there. Yes, now we have the ETFs. Soon it will be Solana ETFs. It has that potential. But the real factor there is, in my opinion, it is the adoption or the inflows, we can say. We saw that inflows in BTC, like a huge amount of inflow, and that actually decreased. In comparison, we saw Bitcoin Vol actually decreased a lot. But that didn't happen in ETH, and because there were not that much of inflows. So same thing when it comes to Solana, when we see a lot of inflows, a lot of adoption in it, that will decrease the implied volatility. That's my expectation. But if that's not the case, we will not see that much of a decrease. So it really depends upon the adoption, how market will actually welcome the ETFs and inflows will enter.
Awesome. Yeah, makes
kind of on this point.
Makes
I think
sense.
that so it's well said, KG. I think the advent of the IBIT options have introduced a lot of new players into the market. I think this will bring a lot of structured products in the market. And there could be some dampening of vol long term. We haven't seen that with Ethereum, as there's not an Ethereum ETF option at this point. And then, like you said, Ryan, there's not any Solana ETFs in general. And so something to pay attention to as the ETFs, the options around the ETFs get more adoption, we could see some impact on the vol long term. And I think this is something really interesting to follow, right? So the advent of more structured products, more options, definitely should have implications on overall Bitcoin vol levels in the US, tradable product market, as well as offshore on exchanges like Deribit and OKX. And so it's a really interesting time in the crypto options landscape. Things are changing quite a bit with the entry of the IBIT options, which have been very successful, right? The IBIT options are now about half the size of Deribit in terms of open interest. And so the market structure is very quickly evolving. It's something that we're paying a lot of attention to. We'd actually love to talk about that here as well.
Yeah, I guess, can you speak to what the broader option market looks like? I mean, again, here we are certainly US centric and tend to think that unless it trades on a US listed exchange, there really is an interest in it. But in crypto, it's really the opposite. As I understand it, maybe 80% or so of trading activity in terms of volumes in perpetual futures is outside the US. Clearly, you have exchanges such as Deribit. How do those volumes in those markets compare to what just now is accessible to investors in the US?
Yeah, so we've been publishing pretty consistent research the last couple of months about the growth of the IBIT options and how it maps the Deribit market and the OKX offshore options exchanges. So as you alluded to, Deribit, OKX are the leading offshore options exchanges. Bybit has an offering, Binance has an offering. we also I sit in the U.S. I'm based in New York, and Volmex is a U.S. company, so we're very excited about the entry of options products into the U.S. for crypto, and we think that this is a major inflection point for the crypto market. Now, if you're a regulated hedge fund sitting in New York or a retail trader that trades through Thinkorswim, shout out to Tom and Tasty or Tasty Trade or a Tasty Brokerage, you can now access these options, and so we think that's a very big win for U.S. investors, U.S. traders. And so, there's a kind of a different profile right now that we're seeing on sort of Deribit market, OKX market, as it compares to the IBIT options. KG, maybe you want to talk a bit about that. There's kind of a difference in the average strike, the average, the average tenor, and the volumes are kind of ramping up for the IBIT product. And so it's really interesting. It's kind of the market structure is changing a lot, and Volmex is positioning itself to sort of straddle both markets. So we would love to kind of enter the U.S. market in a big way, and something that we're working on behind the scenes. And so really excited about the growth in the offshore market, but also with perps and the BVIP product, but also the U.S. capital markets are the most liquid and deepest in the world, and so this is clearly where things are headed.
We've got a question from the chat, if we can entertain it, if you guys have a view here. I think this is a great question. This is from Scramble Everything. How does strategies, or formerly MicroStrategies, their strategy of convertible debt offerings and then the subsequent purchases of Bitcoin, does that affect Bitcoin volatility at all? Have you guys, I guess maybe to rephrase that, have you observed anything structurally that's changed when you have, and I don't know how big of a buyer MicroStrategy really is at times, but you have a player like this that's consistently coming in there? Have you seen a change in volatility across the space since they started to participate in the fashion that they currently participate?
KG, you want to take it, or I can go for it?
Yeah. So I categorize that into like institution, like as more institutions, buy Bitcoin, because they buy and hold, right? So this is in terms of like volatility. It's usually creating downward moves in the volatility. So adoption and more this type of purchases will, in my opinion, decrease the vol over the long term. But at the same time, now BTC has an exposure of risk coming from big firms like MicroStrategy, right? So any problem that MicroStrategy has now will be reflected in the vol profile of BTC, because in times of any distress, any issues, people will be it's not like scared of what will happen to BTC then. So the risk will be carried into BTC, but at the same time, these are institutional players, right? So more institutions entering into market will decrease because of their usually buy and hold strategies. So it's both yes and no. It really depends upon where we are. So currently, a MicroStrategy looks quite strong, so that's why there will not be an effect of its own risk going into BTC, but it's more now like the institutions, they buy and hold, and that's less volatility reflected as less volatility in the market, in the BTC market.
Awesome. Well, hopefully that answers your question there. Scramble Everything, thanks for the question. If anybody else has a question, please pop it into the chat. If you're not on the YouTube channel, pop over there and you can chat with us here.
I got a question. So you guys are crypto OGs. You've been around for a few cycles. You've seen some things, right? So what's your personal view on where we are in the cycle? Are there any similarities, differences from a volatility perspective compared to previous post-halving cycles?
I think, it's interesting. where we are currently in the market, there's a bit of apathy and, sort of some folks are sort of jaded towards where the crypto market's at. I personally think that Bitcoin is going a lot higher long term, this year and in years to come. And so looking for, well into the six-figure Bitcoin. I think, it's dangerous to say this time is different, but this is the first time we've had an ETF on Bitcoin, an ETF on other crypto assets, Ethereum. And so I think the IBIT options, the IBIT ETF have been very, very successful. There's been in the order of tens of billions of dollars that have entered the crypto market, either for just outright, buy and hold strategy or, different sort of, basis trades and things like that by some of the hedge funds. And so I think, the US market is really maturing. Crypto is growing up generally. And I think that this unlocks a lot of big players to come into the market, right? Previously, if you were, a regulated hedge fund with tens of billions of dollars in New York, you didn't have a Deribit account, but now you can trade IBIT, right? And so things are growing up a lot. I think that this allows more sophisticated players to come into the market. At the same time, I think a lot of crypto OGs get a little bit jaded. If you've been in the space for 5-10 years, which is crazy to think about, there's it might seem like things are moving a little bit slow, which is kind of a naive view, I think. And so really excited about where things are at. I think there's no reason Bitcoin can't go to 150K, 200K later this year. It's, in a little bit of a lull right now, but, there'll be some new news eventually and, things will pick back up. And so hard to say what those catalysts are, but, we're builders. We're really excited about this industry and are building products and tools which make it easier to navigate. And so, we think that there's big things ahead, but, not financial advice, obviously. And obviously the BVIP product is very relevant in those types of moves, since though, there should be a lot of strategies and, ways to use our different indices throughout that kind of price action. So I think it looks a little bit different now with the entrance of the, big institutions and ETFs and the BlackRocks and the Fidelities of the world. But the core thesis of crypto still applies. It's a non-sovereign monetary store of value that provides Bitcoin is digital gold, right? And Ethereum, Solana are these sort of decentralized app stores that allow for sort of permissionless, unstoppable applications. And so I think that thesis remains the same as previous cycles, but now we're seeing more sophisticated players come in the market. KP, what do you think?
Well, I can add only maybe the effect of the macro events, and quantitative easing is quite important, because in the previous cycles we always see there is a coincidence of quantitative easing and the bull market. So currently we're kind of on a pause. And it's more likely that it will continue. So that's why we are not there yet, and I think the bull market will continue. But it's very related. It's very connected to the global markets, global money supply. So quantitative easing is quite important here. My personal opinion, of course, but I think we will see with the more rate cuts come, the markets will be more active and more bullish, I guess.
Yeah, I tend to absolutely agree with you there, KG, where I think people at times become very impatient. There is at times this get rich overnight mentality that might exist in crypto. But the real driver really being quantitative easing, the quote unquote money printing, right? We're still going through that period, or maybe we're close to the end of balance sheet reduction. Interest rates are still about 4% with no expectation of a cut even this week. And so I think there's a lot of catalysts yet to come that I'm excited about. One final question for you guys, just from a strategy perspective, before we wrap things up. When you look at the indices that you guys have created, you've got term structure on here. And again, I encourage everybody to go to volmax.finance and check out the charts. It's in TradingView as well. But are there any setups that you look for where you're kind of licking your lips? There's a lot of edge, whether that's for time spreads or anything where nothing's going to work all the time. But are there any specific setups that you look for and strategies that you like to deploy as a result?
One simple thing could be some, events that we see vol spikes. it's also possible that volatility may go even further, but it's less likely, like after we see some, like rare event, then volatility, goes up, jumps suddenly. It's quite expected to see the vol levels to go down, right? So that could be a strategy. Some other strategies could be found as well, but I think this is the simple, maybe the simplest way of exploiting this future of volatility, which is the mean reversion, like we just talked about. Other than that, depending upon your portfolio, it could be a good hedge, but that's more like personal thing. It's not a mean reversion strategy. On top. I don't know. What do you think of?
Yeah, so I think sort of the event vol crush dynamic's really interesting. Going into some of the ETF launches, there was a crazy event vol premium that was kind of priced into BVIV, priced into EVIV, which some folks found very intuitive to see a vol crush right after that. So once the ETH ETF went live, there was a major EVIV vol crush. Same thing with BVIV, with the Bitcoin future Bitcoin ETF launch as well. And so I think, that's really interesting. We had published some research last year about if you had shorted every FOMC, announcement, there would actually be sort of like around 45 or 50% annualized yield, if I remember correctly. Because there's typically a small vol crush after most of those, macro news as well. And so very interesting dynamic with the event vol crush, which is very, analogous to what you see in the equity market, right? With earnings and, events with stocks. And so that's one area. I think that's very topical. When we get the next big Bitcoin date, for some sort of milestone, look for some sort of event vol, rising vol into that event, and then a vol crush, after that event. That seems to be something that there's a lot of actionable trading strategies on. If you had a Bitfinex account or any of the other exchanges that are going to be listing the BVIF, products and other Volmex index products, you'd be able to express a view on that event vol or that vol crush. And so, great question, Ryan. There's a lot of things. It's a very versatile product.
Awesome. Well, appreciate that. And we've unfortunately run out of time. Appreciate you guys coming on the show. I hope that have you guys back on, and certainly, again, encourage everybody to check out volmex.finance. Check out the research that they've put together. Would love to, again, have you guys back on the show to talk through some of that at different points in time. Seems like there's a lot of interesting takeaways there. But as we wrap things up, where can everybody find you guys in addition to volmex.finance? Where should we follow you on Twitter? How else can somebody get in touch with you if they want to learn more about what you guys are building?
Yeah, thanks for having us. This was a blast. We'd love to come back on and take stock of the vol market in a couple weeks, couple months. So follow us on Twitter, Volmex Finance, VOLMEX Finance. We have a Discord with some you can track our indices and ask questions there. But Twitter is a great resource. Add it to your TradingView watch list, right? So search for BVIV, EVIV, SVIV. Some of the other indices we have. If you search for Volmex on TradingView, you'll see we have over 50 indices available there. Download the CoinMarketCap app. Charts.Volmex Finance is our own charts platform. So yeah, check it out. Let us know if you have questions. It was a pleasure. Looking forward to next time. Thanks, Dan. Thanks, Ryan. Great to be here.
Thanks, guys. Appreciate it.
Yeah, thank you very much. All right, that's going to do it for our show. We will be back on Wednesday. Until then, I'm Ryan.
I'm Dan.
Peace.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
In road trips, my family, it was like whoever could get the captain seat was it.
That's great. I'm having a great time.
Me too. But, stay a while. Take your jacket off.
No. I'll stay, but the jacket's not
Come
coming
on,
off.
take your jacket off.
Nope.
Come on,
No.
take it out.
Sorry. I didn't mean that.
No, I'm sorry.
You hopped on this cowboy's horse, so I guess you got to hear his tale. In 87, I took it off. There was the market crash. In 92, NBC canceled Blossom. A couple of years ago, I lost it for 2 days, and the Lakers won the NBA Finals. Bottom line is when this thing comes off, bad things happen.
You've got to take it off sometimes. I mean,
Never do.
how do you shower?
The jacket's kind of gotten used to it. In fact, every few days it needs it.
No matter what, you keep it on.
I can take my shirt off if you want, but I'm not taking the jacket off.
I just don't know if that's something that I could deal with.
It'll be like a teal tornado. Just endlessly washing up on your short.
I mean,
This is moving so fast, and I like it.
Yeah.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Oh, yeah. Tasty Nation, good morning. Oh, yeah. It is Monday, March 17th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. Good golly, they're giving us a lot of incentives, and they're trying to govern. More on that in just a bit. Before we get to the meat and potatoes, let's say what's up to the people. Shout out to everybody watching on tastylive.com, as well as all of you watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. If you don't already have both, go get them. This is going to be a long show, I can already tell. Oh, I got to sneeze, and I'm trying not to sneeze. But if you want to be part of this, nice. If you want to be a part of this chat, you got to hop into the evil Google YouTube. So head on over there and find Tasty Live's YouTube channel. And start typing away metacarpals, phalanges, skull, anything. Bash it against the keyboard. Random ass characters if you want. Anything to spoof Google's algorithm into putting us in front of as many people as possible and helping to deprogram the world. Make the world a better place one view at a time. Shout out to everybody currently in the chat. I would give you a big digital hug if I had consent. But I don't have your written permission to do so. So I'll just give you a digital nod. Shout out to Grumpy Mike, Catan, Big Deal Donuts, Nicole, Adam Green, Victoria, Catan. Did I say your name twice? Go buy a lottery ticket. EB, Scramble Everything, good name. Cato Prime, Son, and so many more. Shout out to all of you. Great to see all of you. What a day. What a day, what a day, my babies. I guess we got to start with price, and then we'll get into all the good stuff. CM says, good to see you. Good to see you too, CM. Hope you all had a terrific weekend. Oh, I'm going to sneeze. It's coming. I'm telling you it's coming. SPX, S&P 500, cash was up 2/3% today. Nice reversal from yesterday. I think yesterday futures open a little bit after futures open yesterday evening. We're down like 0.5%. So a decent reversal from yesterday evening. If you're a degenerate like me, that's how you know. You know what I mean? If you're just if you're half stepping, the markets start on Monday. If you're really down, the markets have been open for a day, 24 hours already. NASDAQ up 0.5%, and the Dow Jones up 0.4%. The Russell was the outperformer. Up a little bit more than 1%, 1 1/5%, just about. And the S&P 500, we've moved up off of that 5,500 sort of basing area, headed towards the top of this range. The VIX absolutely collapsed, my babies. Gold to 4,000. It's coming, says Lincoln. I could see that in the cards. I don't think we go straight there from 3,000, though. I think you got to make I think you got to, it'd be kind of crazy. We go from 2 to 3, from 3 straight to 4. I don't know. It could happen. I don't think it works like that, though. I think we had a decent call. I don't know. Did we? I think we had a decent call. We started selling vol as of last Friday, not the Friday that just passed, but the one before it. Took a little bit of heat into the early part of last week, and up into 30, and then we got a really nice vol crush. A really nice vol crush. Vol come from about 30 down to 20.5, and that's VIX cash. VIX futures down to 1975. A quick look at VIX term structure. And we still got an ugly little sort of backwardation kind of going on here, but not by much. And it really is just 1 month. If you remember, we were in like a 3-month backwardation where you sort of had like March, April, and May. All that term structure was funky, and it was spiked, it was raised. And then June on was sort of in this sort of normal to flat term structure. That's now sort of all settled out, and you really just got March, which is elevated. And, what we had said last week, World Gold Council. Are they listening? we talk about 4,000 gold, and I get a gold ad instantly. Where was I going here? Oh, so a quick note. Why, Victor? Why were you talking about VIX backwardation so much last week? It's just because there had been 2 spots where we had a nice VIX backwardation, and I didn't pull the trigger the way I wanted to. And so last time, I promised myself that if we got into a deep backwardation again, that I was going to do, I was going to kind of go for it a little bit. And so as scary as I think last week was, and to have 3 months sort of in this weird backwardation, I went for it by selling the big dogs, the big VIX futures, which I normally don't play around with. So, I nibbled on a little bit of stuff last week, But the bigger position was selling the big VIX futures contracts. And, even a blind squirrel finds a nut. So that, if you're wondering, why the hell's Vic tweeting so much about Vol Crush? Somebody said, I forget, somebody said, you look like you're in bullish stress. I wasn't in bullish stress. I just took on a really big position. I don't normally do that. And it was just because, I like the VIX backwardation setup. I had said this even on the show. You don't know how long those are going to last. In the 2008 case, we had a nasty backwardation. It lasted for 60-something days. 2011, a nasty backwardation. It lasted for 70 days. See, it could get bad, and it could stay bad. But of all the setups, to me, that's one I kind of want to play. I'm willing to take that risk. As long as I don't position myself to blow up. To me, I think it's a decent risk. Anyways, we're still in backwardation, but it seems like the easy money has been made. Vol collapsed from 30 to 20. I don't know. In equities, 55.50. We never quite got down to 5,500. But, we got close. 5,500. We're now 160 points away from that. So we're sort of 50% of the way between what I think is fair value and the top end of the range. I've said, I think the new structure in the market is probably 5,500 fair value plus or minus 300. So you go test 5,800 and figure out if this resistance is real or not. And on the downside of 5,200 might be a decent washout. I don't know that we ever get to 5,200 though. And I think that's probably the new sort of range we're in. And I don't know, it seems like maybe some of the easy money, which is the vol crush, has been made, and maybe not so much in the equity side. I don't know that I'm that. I don't know how to think about this market though. How to think about the market at the major level. Because if Russell's outperforming NASDAQ, you know what that means? It means what people are buying. They're still not buying the Mag 7, right? It means they want to go. They're finding other values to deploy capital to. I'm not sure what that says about the overall market. Let me know. What were you doing last week? Were you running around like your hair was caught on fire? Fear mongering. Were you picking up some stuff? If you picked up something, what did you pick up? If you didn't, if you were doing neither, what you might have been doing is sort of closing out shorts, looking for a new opportunity to lean against this thing, to get short to the downside. And I'm not mad at that either. I think ultimately I think that's still probably the play. Real estate was the outperformer today. Gosh, give me a second. Let me read some of this. Gold to 4,000 is coming. I already read that one. This morning, it was in contango. Scramble, was it? I missed it. I didn't see it go back to contango. That probably makes sense, right? They probably crushed the last of all this morning. It got cheap enough for people to buy some short-term protection again. It's again, not a good sign. How many years of growth will the U.S. miss if not participating in a program like China's Belt and Road Initiative? That's a really interesting question. Night moves, last but certainly not least. Skew at 133, nothing to see. 57, 54 was resistance. You mean support? 57. Oh, 57.54 was resistance. Down move coming tomorrow. Okay. Intel over NVIDIA. Whoa. Gotta be kidding me. Who said that? Who said Intel over NVIDIA? You're just saying today's price action or what? I mean, I get it. I mean, you got to close your shorts. Oh, I think that's what you're saying, Katan. It's that Intel was up nearly 7%. NVIDIA down still 2%. at some point people realize it's not even that they're better companies, Katan, and I know you know this, but like at some point, so much good news is priced into a concentrated 7 stocks that like an incremental dollar can't make sense there. And so much bad news is priced in that like, I guess all I'm saying is risk and reward. All I'm saying is risk to reward, basically. At some point, the risk to reward of a long bet makes more sense than short, even if it's a bad company. And even if all you know about that bad company is that they've changed leadership, at some point, an incremental dollar in a good company doesn't make sense because of the risk and reward. And I think the good news, I think about like NVIDIA, and Microsoft, and Amazon, and Tesla. I think the good news is that some of that concentration risk, some of that perfection in the market is getting priced out right now, which, I know it's probably painful for a lot of people if that's what you're concentrated in, or that's what you've sort of been riding the momentum trade, or just from, I think, most people's 401ks, it's all in this stuff. And so normalizing the paper market, this is the one of the things that I was thinking about this weekend is, let's say any of this is successful, and I don't want to start some political argument. It's too early for that. It's a Monday. I don't want to start some political argument, but let's just say any of the objectives, let's say any of these tactics accomplish your objectives, which is, over the last 15 something odd years, you could say longer, but let's just say specifically the last 15 years, a lot of the growth has been paper money growth, right? We attract capital. That capital has gone into our assets, and we've had asset price inflation to the benefit of asset holders, to the detriment of asset light, as Chamath would say, or effectively those that don't own assets. It's come at the detriment. And not only has that happened, but also we've sort of hollowed out we've hollowed out manufacturing, we've hollowed out a lot of strong working class jobs. We've sent them overseas. And if you imagine like what we're about to embark on, whether it's successful or not, I do not know. Whether we have the stones to go forward with it when it starts to get painful, I do not know. But if we're attempting to normalize this, you just have to think back and go, okay, well, what were the flows? The flows were TINA. There is no alternative. All excess liquidity from the world gets filtered back into U.S. markets. It used to just be buying treasuries, but in a post-ZIRP world, that buying treasuries, they were still buying treasuries, but like what else? A lot of that money came in and bought U.S. tech stocks. And the real economy in the U.S. suffered, while the real economy in a lot of other places flourished. So if what we're trying to do, I suppose, is improve our real economy, and that will likely come at the expense of our paper economy. Not the full expense, but at some trade-off. And it will come at some detriment to international real economies with some benefit to their paper markets. And you're already seeing that. You're already starting to see over the last month and a half, maybe 2 months, a change in capital flows. We've talked about it a little bit, but and I think Ilya would take issue with the framing of this, and I'll talk to him about it tomorrow. He would call a lot of this currency related. But I do think that you can already see a difference in capital flows to international markets. Europe being one, Japan being another, China being an obvious one. And I'm not so sure that that's a short-term trend. I'm not so sure that that's going to be short-lived. And so, yeah, I look at charts like this one, VGK, and on a 1-year basis, it's not the most enticing. You know, a contrarian would look at that and say, how do I fade it? I know FXI, it's a really difficult market to look at and go, I want to buy some of this stuff right now, given the moves that it's had. And I'm not saying that this is the most advantageous place to execute a long into this, but I'm just saying I'm not so sure this trend is over if we're going to actually stick with this policy for the next at least 4 years. For better or for worse. Again, I'm not here for political discussion on this early, maybe a little bit later in the show. My whole point is I think that the international flows to me make sense as a risk to reward bet. Let's see here. Seems like Tesla could be better for a bounce than Nvidia. I'm not. Yeah, somebody called for Tesla 170 or 160 the other day. I think that's what Pete said on First Call. I think that's kind of crazy. I remember we were loading them up here. They were giving it to us at 170. And then I felt like a dummy. I think I got rid of it at like in the threes. Can't believe we're back at 240. But again, this is how funny the market gets, you know. Tesla at the end of the day, they sell cars. And it's like people forgot about that. You can sit at the throne at the right hand of the president. But like, how much of that should you be pricing into the equity? You know what I mean? At some point, markets get silly. They get silly and they go, I got to be in this thing. I don't have enough exposure. And people stop caring. They become price insensitive. And you get a Tesla stock that's gone from 225 to 500. And you're going, they haven't sold another car. In fact, people are boycotting the cars. You forget about that. But anyways, at 240, it is getting pretty cheap, I think. I think it's starting to get pretty cheap. Would I love to see it at sub 200? Yeah. I don't know if we're going to get there. I'd love to see it at sub 200, though. Even then, it's not like you're getting deep value for it. Earnings on April 22nd. It'd be nice if they could bottom it out but prior to earnings. Oh yeah, we can sell some pretty decent puts here, sub 200. Those 180s, 185s. If I'm being a big chicken, maybe even the 200s at 550. That doesn't look too bad. I'm not going to pull the trigger now. But I don't know. That's starting to look pretty decent. An interesting risk to reward. CM says equal weighted fund would have been better going into this stuff for sure. Equal weighted fund, I think outside of the NASDAQ. There's an equal weighted NASDAQ. I don't know that I'd be touching that. Moving jobs overseas was way before 15 years ago. I know, CM, I said that. 15 years ago was ZERP. Moving jobs overseas probably starts with China to WTO, so like 2000 is where it goes hyperspeed. Manufacturing difficult now. Many of the Tech 7 have taken over the power supplies that manufacturing used to use. They use it to power data centers. Bingo, night moves. The thing is, they've done a lot of like MOUs, which is here. Let me say it this way: I've started to acquire a lot of utilities and energy companies on this premise that if the market doesn't buy them up and increase these valuations, if we continue to have cheap utility and energy valuations, then the tech companies, why wouldn't they just buy them up? So it's either the market is going to revalue these things, or some of these will likely get purchased. And we saw some of that. It didn't get outright purchased, but like the Microsoft deal with Constellation, CEG, I think that'll probably be, that model is probably something we'll continue to see into the foreseeable future. I think tech is really smart. Here's the flip side of that. Tech is really smart, so they'll figure out how to buy a company without buying it. Case in point, Microsoft and OpenAI. What a charade that thing is. Nonprofit, you-know-what. I would own, CM says, I would own NVIDIA long-term before Tesla. For sure, but for bounce, seems like Tesla has so much negative in it. Where's NVIDIA at? I agree, but NVIDIA is not that. I mean, last week it was at 108. I say 108 because that's my purchasing price. I know it got lower, but I keep saying 108 because it's 108 to me. To me, like it's at a I don't know. 108's not the worst price in the world. I say that as somebody who bought NVIDIA, wrote it up to 900, which would have been the equivalent of $90 before I sold it. So everything after 90, I didn't participate in much, if at all. I think a few times it got back down to like 100, then I got back in. But it's sort of funny how that works, how opinions can change over time and space. That at 90, which was 900, which is effectively 90, I was like, all right, this is a bit expensive. Now, if we got to 90 again, I'd probably go, this might be cheap. Funny how that works. Victor, it's time to buy Alcoa stock. Aluminum getting up to all-time highs. I bought more Albemarle last week. It's not the same. It's lithium, but we're in the ballpark of materials here. That's not an ugly stock. I'm not mad at that idea, Catan. John Stein says the payoff for Elon Musk will be regulatory approval of self-driving, and the stock will be worth $800 a share. I agree with that, John. I do agree the payoff is self-driving. I don't think it's that straightforward, because I think that's it will be helpful, but you still got to still work with the states. But I do agree with you, federal approval will be helpful, and it will increase the value of Tesla. Let me not say that. I can get in trouble. I think it does make Tesla a more valuable company in the long run. But I don't think you do that at first. If you're Trump, that's your chip. That's probably the only chip you have on Elon. And you're not going to do that early in the administration. You know what I mean? That's like a Biden pardon. You do that walking out of office. I'm sorry. Okay. I do like the Alcoa play, though. I'll look at that more. I don't know much about the aluminum market. We sold Newmont and added to Barrick. Oh, Catan. Yeah, at least you're in the ball. At least you're in the gold miner, so I got no problem with that. But why are you going and chasing the performer? You're going after the thing that's working. I get it. You're selling the thing that's not working, going after the thing that is working. I would do the opposite. I'm in both. So I have some Barrick Gold, which is GOLD, and I have some Newmont Mining. My Newmont Mining is bigger and getting bigger. But Catan, I think that's kind of when people first started going after the gold miner theme, they went after Newmont. And then it seems like the money sort of spread out. It's gone into other places, Agnico, Eagle Mines, Barrick Gold. Even some of the silver miners finally started to perform today. We had a nice breakout. I'm in this one, Pan American Silver, PAAS, which was up 3.5% today. So a nice breakout to the upside. I think the silver miners to me are interesting. Gold miners are still interesting. And if you think gold can get to 4,000 in the next year, which I do think, but I don't think we go straight there. And if you don't think we go straight there, how do you get exposure to an increase in gold price without sort of top ticking a gold move? So I think Tom's instinct, we had a conversation on first call yesterday. I think his instinct is right. At any minute, we could be down 5% gold. And if that's true, I would rather be in some of the miners, which I think are still trading at a discount relative to the gold price. People just don't believe in this move or something. If you look at GDX, these are the big miners, made a new high today, up 2%. GDXJ are the junior miners, so a little bit higher beta in this one. This one was up 2.6% today. Another high as well. It's just, I don't know. You try to tell people, but they won't listen. They just keep buying Tesla calls, NVIDIA calls. And that was the game, that was the game for a really long time. So you could just say, yeah, okay, whatever, boomer. And you just double down, buy some more just outright naked calls. And then they just smoke you on performance. They're like, what are you doing? And you give them some complicated, description of how you're trying to mitigate risk, and you go, what are you doing? I'm buying Tesla calls every day, bro. It's like, all right. That's what the game was. And I'm not, I don't think, I don't know, I always say this, but it seems like the game is changing. At 5% cost of capital, a little bit more difficult geopolitical situation to navigate, harder just politics and policy read-throughs. People being a little bit less straightforward about what their real motives are as well. I think all that makes this more of a poker game this time around than it was before. Let's see. Noah says, Victor, gutting of the American manufacturing base is something I don't know much about, but I think it's been going on for 50 plus years. U.S. capacity won previous world wars, then won too. Somehow it became less. Somehow it became less important. Yeah. Again, I don't know if you guys are earlier in the stream or what. But the inflation part, the asset inflation part, I think I conflated these or spoke about it too loosely. The asset inflation part starts around 15 years ago at ZERP. It's been happening for a long period of time, but I'm saying it went on steroids when you drop the cost of capital to zero. And the hollowing out of manufacturing, I agree, has been going on for a long time. But again, it goes on steroids when China joins the WTO, which is about year 2000. So you make arguments for these cases as sort of long, not drawn out, but like longer term trends. And I'm down with that. I'm not going to argue. I'm just saying these things go on steroids in the year 2000 and the year 2008. Bonds, interestingly enough, have been a whole bunch of nothing. So we're at 117 here, the long end of the curve. And this is a really hard call. So there was a period in time where the only thing I wanted to trade was bonds. The only thing I wanted to trade was bonds. I could not figure out what the hell was going on in equities. I'm slowly starting to feel the exact opposite. I'm slowly starting to feel like the risk and the uncertainty is in bonds. And I'm feeling a bit more comfortable with equities, and I'm going to explain why. I think the tough part with yields is figuring out just what is the appetite for pain. And I don't know the answer to that. I don't know what the answer is for pain here. I don't know what the answer is for the appetite of pain. And if what they're saying is true, if what Besson is saying is true and the Trump admin is saying is true, then yeah, maybe bonds are really interesting. They're still at an interesting level. But if they're bluffing, and it's hard to know if they're bluffing, right? Because with all the talk of cuts and layoffs and all of this stuff, they also put a budget. They're doing a budget by continuing resolution, which if you have the House and the Senate and the executive and the judiciary, why wouldn't you take this moment when you have all this political capital and political favorability? Why wouldn't you take this moment to actually do a real budget? Why would you do a continuing resolution? And why would you be passing Biden's previous budget instead of putting something of your own out there? So you get to like continue this spending. You get to continue this spending and just say, this wasn't mine. It was a previous administration. I don't get what they're doing. So on one end, they're talking tough. And on the back end, you're passing a budget that'll increase the deficit by $2 trillion. You're managing by continuing resolution instead of an actual budget. It's like I can't figure out whether to take them serious, and I think the truth is probably somewhere in between, which means, I almost want to short bonds at 120. I feel like shorting bonds at 120 is the more interesting play if you had to do anything. But 120 doesn't feel like a great level. So I don't know if this is helpful or good streaming content, but I think maybe 125. We get to 125. They happen to give us a gift. Maybe that's the level to start playing against it. Because I don't think they've got it in them. I honestly do not think they've got it in them. So I think they'll create the narrative of the fiscal conservative. I think they want to wear that uniform, but I don't think they want to execute. I don't think they want to do the dance. You know what I mean? They want to wear the dress and they don't want to dance. I don't know. I don't know what that analogy is. But the bond market gave them a little bit of credit at 112. It seems to have gotten stuck here at 120. And I think we're getting close. So I think the risk and reward makes a little bit of sense to bet against the long end, especially going into FOMC here, where they're going to have to put a new SEP in front of people. And if they listen to the bond market, they have to lower inflation and lower growth expectations, right? Because you got to do something. You can't just put this same thing in front of everybody, this same summary of economic projections. You've got to do your job. And the last time we had this summary of economic projections, GDP was going to be at 2.5%, or excuse me, 2.1% for 2025. Unemployment rate at 4.3%. PCE inflation at 2.5%. Core PCE at 2.5. Fed funds at 3.9. So they have to true this up a little bit with 3.9. They have to true this up with the market a bit. I don't know. Maybe they don't. Maybe they don't move anything. Yeah, that would be wild if they almost they don't change anything. He says nothing. That would be so perfect. He says almost nothing. He stays neutral. He acts like Mr. Magoo. They put out the same SEP or nearly the same SEP in front of people. They say good night. We'll see you in 3 months. I don't know that anything sticks out at me as something they must change on here, or it's an easy change. Uptick downtick says, imagine believing anything the Trump admin says is true. Imagine believing anything any president says is true, bro. That's the whole game, is figuring out what they're lying about and what they're telling gradients of truth about. The thing is, if he contradicts himself, he can't always be lying. You get what I'm saying? So, these narratives are always funny. What are you trying to guess? There are competing pressures, which is keeping bonds in this zone. Yeah, I agree, Scramble. That's what I'm saying. What I'm saying, I'm not trying to guess anything. I'm trying to figure out which side of the coin I would rather be on here. And I think it's so hard to sort of pick one that I'm trying to articulate why I don't love being long or short bonds here. Because I can make the case for either, and I don't think it's at an extended position that lends itself to, or if we were at 125, as I said before, I would really like the opportunity to get short there. 110 was an obvious level. I mean, in hindsight, at the time, it felt obvious too. That 117, 118, I don't necessarily know that bonds are off sides in any direction here, and I don't know that I want to be on any long-term trend play for bonds. I'm not trying to guess anything. I suppose I'm trying to articulate myself as well as sort of figure out if what I'm saying I actually believe in. Because I'm not in a bond position, so I am flat, and I haven't thought about where I would want to go long or short and why. And I sort of wanted to take a moment to think through that because I realized I hadn't done it in its FOMC week. And FOMC week can create some volatility for interest rates. And I want to go where the vol is. But I don't know that I have a strong opinion. So I think this is one of those cases where I just wait and I see, and whatever the market gives us, we'll play it from there. Add liquidity and fade whatever the market does. Is probably my game plan for FOMC. I don't have really strong bias and opinion. Scramble Everything says we are not getting 125 ZBs anytime soon. I think you're right. I think they thought it would be business as usual, but Trump needs a little time to get things going in the right direction. VM, that's the narrative. That's what they're saying. That's what Senate Republicans are saying. But I think that makes no sense. If your favorability levels are high, you do it now. Getting time to get things done that only adds risk, right? Vol is synthetic time. The more time, that's why your vol term structure normal is contango. The more time you give something, the more potential for something to go wrong. So if you actually wanted if this meant something to you, if you weren't just effing around in the cloak of the fiscal conservative, but you actually needed the government spending, you needed some of that fiscal impulse to offset the vol you were creating, which I think is what this is. They need, just in the same way the Biden admin needed the fiscal impulse to offset that raise in interest rates. I think in some ways the Trump admin needs some of this continued spending to offset the vol from some of the trade policies. And I think that's what that is. And they're saying, oh, we need more time to whatever. I think that's BS. And so the risk is, if this doesn't work, your favorability levels are going to drop. If your favorability levels drop, you can't cut. You have to spend. Like politically speaking, anyway. Catan says, term premium got to be costly, Victor. Investment, long bond, and USA skittish. CM, one of the Nigerian brothers told me also they all lie. Anyone on CNBC has suggested unusual volume of option trades means something. That was good. And Lobo says, all right, I'll do one more and then I'll start going here. The government cuts and tariffs could take months, years to show up in data. I disagree with that. Right off the bat, I disagree with that. Once it does though, the momentum will be hard to stop. Thinking whichever way the bonds move, it will be big. Yeah, there's a part of me that thinks the economy was always slower than what they were presenting, and we just really gamed. In 2024, we just gamed what we should have run into 2023 and 2024 with just like this massive fiscal impulse. Whether it was right or wrong, we just gamed it. It doesn't mean it was stronger. The economy was strong, but we needed that narrative. And now I don't think tariffs are helping, but it gives this illusion of control. But I think if he never does the tariff thing, never says anything he can in Mexico, this thing was slowing. And I think I think that's sort of his style, to try to pretend like he's always in control. But I also think it's probably not politically smart, because that's going to give everybody an out. It gives the Fed an out. It gives political opposition an out. But I don't know. It's a big card game. And I get the reasons why. In theory, I get the reasons why. To me, I find it interesting that people have a hard time steel manning stuff. Let me run something by you. I was trying to get to like the simplest way to explain what's happening. I try to do that because I'm not the smartest guy in the world. So I try to get to the simplicity of something. And I think, like, if you were running for president and you promised peace and you promised fiscal discipline, and as commander in chief, you sort of you've got two things you can execute foreign policy with: a carrot or a stick, hard power, soft power. So the soft power is through economics, right? Our printer is shut off at the moment, theoretically, because you promise fiscal discipline. Hard power, you promise peace. So you put the carrot and the stick on the shelf. What's left? And I think if I was thinking through this, and I'm like, all right, if you promise peace and fiscal discipline, how do you execute hard power or soft power? And I think that's how you land on tariffs. Not saying it's right. I just think that's where he put himself. How do you execute any hard power or soft power to the world if the whole world knows you want peace and the whole world knows you don't want to spend money? I know I'm oversimplifying, but that's sort of what I'm trying to do. I'm trying to get to like the simplest explanation of what's happening right now, and I think that's not the worst explanation. All right, GC gold up to 3,000, up above 3,000. We knew we'd get here. It's just a matter of time. We finally are here. I think it'll be. I don't know. Normally, I would say you get to 3,000 and you'll probably get a big puke, right? I don't know that happens, and I'm going to tell you why. I'm not going to say I don't know that'll happen. I won't bet on it. I'm going to tell you why I won't bet on it. Because this consolidation here, if you wanted to puke or you wanted to take some chips off the table, you were waiting. You were waiting for like a month, and you were at 29.50. You mean to tell me there are a bunch of people that waited through that consolidation just to get to 50 points higher to dump it? I don't think that's how this game works. I don't think that's how that game works. So I wouldn't bet the dump here. I'm not saying it won't happen. I'm just not going to bet it. I don't love the setup. CM says, I live for steel manning and do it regularly. Finding the best argument for something doesn't make it the best logically sound argument. Yep, I agree with that, CM. Agree with that 100%. But I think it's a test. I think it's I won't. Let me say this. I'm gonna be careful of the way I say this. I think arguing with somebody. I think before I engage in like a good faith debate, finding out if they've taken the time to research the opposition is a worthwhile exercise. Because it's like, am I just debating somebody who just constantly gets on the internet looking for facts that back up their already existing point of view? Or am I having a conversation with an intellectually honest individual who may change my mind, who may change their mind? And I think just at least framing what type of conversation you're about to get yourself into, I think is helpful. Because I find one type of person exhausting to have a conversation with, if you're blindly defending a point of view. And I don't know how, I don't know how people fall into those buckets. You know what I mean? Like if you grew up in Chicago and your father was a White Sox fan and he was a Bears fan, he was a Bulls fan, and every day, you've got memories associated with those teams. I get how, as an adult, you're a Bulls fan, and you're like, I don't like the Pistons, or whatever. I don't get how people do that with politics. I do not get it. Like, I could understand if you did that with a position. Like, I have a policy stance, and this is what I believe. I think so many people just riding with teams. And then it's interesting because if you've known somebody for 20 years and you go, okay, what do you think about immigration? And if you've known them through the Bill Clinton era, when unions were 20% of the workforce, and the Democratic Party was pretty staunchly anti-immigration because of what it does, because of the threat to domestic workers and wages, then it just flips, completely flips, and people go with it. And that's the part I don't understand. Same thing with, I can do the same thing with the Republican Party too. Like how do you just ride with a group of people who change completely on like fundamental positions on how to think about the world and the economy? How does that work? I get the politician's incentives to just switch his mind or her mind and opinion based on their donors or their incentive structure. But you as the individual, why are you changing your mind every 7 years? How are you getting talked into changing everything you believe every 5 years? That's I don't get that. And I don't like it's not like I don't like talking to those people. I just don't take them serious. I can't take you serious because you haven't sat down to do any work. You sit down to do any work and figure out what you believe about the world, or are you just scrolling enough that you saw enough images and memes that now you believe something? And if I just spend enough money, I can make you believe something else. Yeah, anyways, sorry. I got off on a tangent there. Anyways, I like the gold mine. I've said this a million times. I like the miners here. I don't love a long gold, even though I think if I had to be long or short, I'd be long. I could definitely see us waking up and being down 5% in gold. But I think if that happens, I'll just end up buying more miners on gold volatility. I think silver miners are pretty unloved here. If I had to take a bet, I kind of like silver, which is weird to say near these highs at 35. So I wouldn't take a new long. I would do the same thing. I don't want to say that. I wouldn't do the same thing because it's not the same setup. The silver miners are not as cheap. They are at highs along with silver, so it's a little bit different setup. Copper, again, we talked about this on first call, near highs. But the equity's still trading at a bit of a discount, but they've just started to take off the last 4 or 5 days. And that's what happens, bro. That's what happens when people wake up to these things. They go, oh, wait, copper's at the highs. And the thing that makes 70% of its revenue is at its yearly low. Does that make sense? And everyone says no. And you get this $5 rally in Freeport out of nowhere. And that's the easy money, and then it gets harder from here. Yeah, so I've sort of been I've been very consistent about the ideas that I've been on, and I'll probably be consistent. When they start working, then I'll come up with a new set of ideas, because that's the game, right? Don't run these things into the ground. Look for those easy money opportunities, and then when they're gone, we'll figure something else out. But I still think Newmont's a decent bet. I still think Freeport is a decent bet here. I like Albemarle. This one's lithium. I talked about this a little bit earlier, but this one had a nice little bounce today of 5.5%. And wasn't this like, didn't Kramer say don't touch this last week or something? I like the idea of accumulating some materials here, and I've explained why, but I will just really quickly again. in a world where multiple participants, we're going from globalization where you are just looking, you have sort of this global supply chain. Somebody's adding materials. Whoever has access to the cheapest materials is adding that. Whoever has access to the cheapest labor adds that. Whoever has incremental marketing and shipping, all that stuff, just the world participated in like this sort of singular and efficient supply chain. And that works in a cooperative world. And people are no longer cooperating with each other. The cost of capital goes up. And for national security reasons is what everyone is pitching. You need to go away from this sort of globalized supply chain, and you need to build your own national supply chain. And that seems to be repeated in multiple countries and territories. But if all those people are recreating their supply chains, they're gonna realize at some point that like, oh, we need 3 times the materials. And I think the setup is, and not only that, but you have this situation where if we're not careful and we trip some credit event, or we have to go into QE again, or something like that happens at some point in the future, maybe not today, maybe not next year, but you have a situation which would be very beneficial to all hard assets. So Bitcoin, gold, silver. I think in a way the market is sort of leaning that direction right now. It's like, let me lean towards the fixed hard asset that the central bank cannot print. I'm going to lean into that direction. That's what seems to have been happening. And anything that the central bank can print, people leaning away. And so I think you trip some sort of credit event, or this gets ugly, the negotiations get wild. Yeah, you're going to need to turn the printers back on, and that's going to be extremely beneficial for every hard asset you can imagine. Bitcoin especially. And I don't know why you don't. There's a part of me that goes, isn't it inevitability? You know what I mean? And so there's some part of me that totally gets what the Bitcoiners see. I can make the arguments against it, but I do see what their end game is. Let's keep going. We'll do sectors really quickly. So I started off doing this and I left the topic. I think I went with the chat. But real estate up 1.7%, a little bit of a bid into this area we've been watching, which is the home builders finally got a little bit of a lift, and XHB and ITB, we track both of them. The last 2 sessions, not much, but a 2-day reprieve of the selling after hitting lows last week. I watched a bunch of stuff this weekend, which I normally don't do, but I did watch a bunch of stuff this weekend, and I saw a lot more people speaking about the housing market. A lot more people speaking about these home builders, and the lockup in housing, this pause in housing. I think as soon as we raise again, as soon as we cut again, I think our fortune will be told by the long end. If the long end lifts again, we've got real big problems. If we kind of stay where we're at or drift lower on a cut, we're going to be okay. Like the economy might be might be an okay. I'm not going to call it strong shape, but it might be okay. If the long end lifts, we're screwed. I think that's the way I see this. If the long end lifts even higher, we're going to be screwed. Home prices are coming down, and they're coming down hard. But if it plays ball, if we cut and the long end falls or doesn't lift, this might actually work. This thing might actually work. So I think that's the thing to answer all questions. We shall see. Last one here is going to be crude oil, 67.16. The first, what was it, 2 weeks ago, sort of was the first floating of a headline that I'd seen about doing something with the SPR. I think this is a hard market, given the negotiations going back and forth between the U.S. and Iran. This is another one. It's funny because I used to be all give me crude oil, give me gold, give me silver, give me copper. And I used to be playing all of those things through futures options. Now, I don't love any of those markets, and I love their equity counterparts. So I don't love copper, but I like Freeport. I don't love gold, but I love Newmont. I don't love silver, but I want silver miners. And I think in energy, it's the same. I think crude oil is a hard one for me because I can't figure out the incentives. I know that we want a lower energy price, but we don't want it too low. And picking a spot here in crude oil, it seems impossible. If you're getting a low price, I think you've got any day you could wake up and the U.S. admins floats a headline about filling the SPR. So shorting it becomes hard, or they have a tough negotiation with Iran. I just think the underlying market here is filled with really difficult catalysts. So I would rather be in long energy stocks here, which I think have been unloved. And for the right reasons. I think everyone is discounting more supply in the market, but I like energy stocks too. And over the last 3 days or so, people have been scooping these up too. But I think energy makes a lot of sense for the long term as collateral. All right. CM says, we arguably need home prices coming way down. Boomers need to relinquish and find some humbleness for the first time in their lives. I don't disagree, CM. I'm going to take us out on this. I don't disagree with you. So then, how do you do it? We only have one mechanism to like clearly take the home prices down, and that's to jack interest rates. But if we do that, people lose their jobs. We go into a deep recession. So how do you do it? See, the hard part that we're in right now is everyone wants lower prices, but nobody wants to go through the difficulty, the challenge, the stress that it requires. Because you don't just get to say, okay, all prices go down and everyone keep their jobs. Everyone keeps their house. Everyone keeps their health outcomes. There's no magic button that does that. And so, but then if you're one of the people that says, I'm willing and I'm ready to go through the pain because I think the other side will be most beneficial for most people. If you say that, people think you're unrealistic. People think you have a lack of empathy. But it isn't a lack of empathy. It's this train only goes one direction, and you're not going to like where it heads. It heads to more wealth inequality. It heads to authoritarianism. And this other place, it's not perfect. It's certainly not perfect, but it's better than where that train goes. And yeah, so that's sort of it's a really difficult thing to articulate because people think you're either crazy, unrealistic, or you have a lack of empathy for other people, and it's just not true, man. I just think of the two options, one of them is much better for more people. Not perfect, but better. If rates are up, retirees can earn more interest in savings rather than market risk. You're explaining why your vote wasn't a great idea. Oh, CM. Oh, you're brutal sometimes. Inflexible might be the word. I don't think that's fair. Sorry, I shouldn't say this. I have the microphone. I want to thank all of you. I think that's going to do it. I want to thank all of you for tuning in with me for nearly 90 minutes here. Do me a favor, hit the like button before you get out of here. Subscribe to the channel if you haven't already. Follow me on Twitter at Victor Jones. The Owen Jones is a 0 because I like to be difficult. It's a big week this week, especially towards the tail end of this week. With the FOMC announcement, there's some pretty decent reports. It's quad witching week, excuse me. So there's a lot riding on this week. The interesting thing is they already took all the vol out, right? Like if I told you this was quad witching, you've got FOMC, and you were coming into this week at 30, you would say, well, oh my God, I'm selling vol for sure, because you got to have a massive vol crush regardless of direction. What's so sick about the market is we got to what is a more neutral level going into this week at 20. But that's what the market does. It finds the exact pain point. I will see you back here tomorrow with a conversation with Ilya Spivak. I definitely want to focus on international markets with him tomorrow. If you want, do me a favor. You can tweet at me if you have specific questions or topics that you'd like Ilya and I to cover for tomorrow. I don't normally do this, but I am curious what say the audience here. If you want to, go ahead and tweet me, and I'll see if I can incorporate some of those topics into the discussion outline for tomorrow. Otherwise, I'll see you back there. I'll see you tomorrow. Same time, same place, same great network, only on Tasty Live. Peace.